Hello, everyone. Welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from X. I'm very glad to have one familiar name when it comes to precious metals with more than 50 years of experience in that field, and that is Michael Oliver. Mike, thank you for coming. It is great to have you in my show.
Great to be here, Lucian.
Thank you very much. Mike, let's start with your views on the stock market and possible correction down the road. How do you see that playing out? Will we see a meltdown or a correction of 10%, 20%, or even 30% correction? What's your take?
Well, I have to applaud at least one institution out there that normally, you don't care what the institutions say, right?
Yeah.
But JP Morgan and Jamie Dimon have argued and repeated themselves like a week ago at JP Morgan Research said, expect a 20% drop in the stock market this year. Okay. I think that's conservative. Okay. I'm a major bear. And you look at the price charts and say, well, how can you be a major bear? Well, we look at momentum of price and we plot it like you would plot a price chart, with bars, monthly bars, weekly bars, so forth. But we oscillated against certain averages that are determined by the market itself. In other words, if the average is rising sharply, so is the market, But we plot the monthly bars, let's say of NASDAQ 100, for example, in its relationship each month to, let's say, a 3-year moving average. So how much above it, or how much below it is it? And when you plot that kind of chart and go back to like the 2009 bear market low, for example, and plot all that history, you see that in the entire bull market, a dozen years of it anyway, up until 2022, the momentum action remained in a rising tube, a parallel channel, in fact. It was so perfect. You had like multiple highs and multiple lows that all just lined up mathematically. It was beautiful. Look at the price chart, you don't see that. You see an up, but you don't see a structured channeled type situation. It was just sort of a curve. Well, we argue it's the biggest bull market bubble in US stock market history, both in duration. We're now 14 years off of the low. In percentage gain during that time, you can't find a prior bull market, including 1929, mid-1970s, the dot-com top, or the real estate top in 2007. None of those compare in duration and in percentage gain over that period of time. Exactly. You say, well, everything must have been good in the US, right? Well, yeah, it could be, but also look at M2 chart. The money supply growth accelerated. And prior to the bull market, each of those bull markets, in fact, you'll see several years of the Fed taking interest rates down to sub-market rates. Well, this time around, starting in 2007, in fact, they cut rates all through 2008, all through 2009, and then they did their QE. Of the prior 14 years, 12 of those years were effectively at zero interest rates. Okay, so you want to know how the tank got filled to create this huge bubble? Well, you look at those two charts, Fed funds, money supply. Okay. That was true with all the other prior bull market peaks and bubbles as well, except less exaggerated. When this bubble breaks, and we argue that in early 2022, the technicals broke the integrity of the uptrend. Sure enough, what happened right after our sell signal in January of 2022, which was like 6-7 weeks off of the traded high of the NASDAQ 100, I quote it because it's the leader index. Yeah. The market collapsed pretty severely, like 20-30%. Then it based late 2022, and then so over a span of 2.25 years now, finally it went up and made a new high. Okay, and everybody's so impressed. But it took it 2.25 years to do that. So in other words, if you got out when we suggested getting out and went and bought T-bills, you did better than holding into that market. Anyway, forget that. The new high does not change our view, the new price high, because momentum, when you look at that same momentum chart that I described to you, and we had it in a recent report, it's the most laughable chart you've ever seen, because all that dozen years of nice upward parallel channel, perfectly hemming and hawing all the way up, but well-defined, all this rally has been up under that momentum channel. So when you look at momentum, you say, gosh, if that were a price chart, I'd short it right here. okay? And you probably should. We think that what's going to follow will be probably the biggest bear market in U.S. history in terms of pain. And I don't just mean pain for people who own stocks, but people in the street, so to speak. Remember 2008 and 9, it wasn't just stockholders that were hurting. It was the average guy got laid off, his pension fund, et cetera, et cetera. This one should be worse because the overdose of drugs, free money, lasted longer, and therefore the hallucinations and bad decisions that are made by individuals, families, corporations, et cetera, based on the notion of free money is now exposed as an error. And they have pain to pay, okay? So we're watching the technicals, and I think that's going to have a big impact also on what gold knows. And I think gold, being a monetary metal, been around 3,000 years. So it's not like, T-bonds or the Federal Reserve been around a century.
Yeah.
Why has it been so firm, despite the Fed wanting to cutting rates, fighting, quote, inflation, as they narrowly define it? Why has it been so persistent and now starting to accelerate? By technical metrics, we think it's in the acceleration phase. And silver's now outpacing. But why has that been occurring? You can't figure it out. Well, the reason I think is that they know that ultimately the so-called tightening of the ECB, of the Federal Reserve, is going to switch and go back the other way. They'll have to. What will cause that, especially in the US, is some change in some data points. You can already tell underneath the lines of the conversations and speeches given by Fed governors that they have this tough tone about we're going to keep it tight. We got to fight the inflation. But on the other hand, they keep citing certain things that do concern them. And what they're looking for is an excuse to go to their other mandate, the other mandate being the employment issue. And we all know that if you look under the surface of the employment data for the last 4 months, for example, and look inside, where have the jobs been created? It's been hospitality, waiters, bartenders, maids, home health care, somebody to come take care of your grandmother, for example, government employees, and a sizable new government employment, sizable percent of all the, quote, job gains. So it's been false. So what I think they're waiting on is some kind of data point. The problem is that when you go back in history and look at those data points, usually they don't really start to accelerate on the downside until the stock market leads the way. It's not the other way around. Yeah.
So
I expect to see that. Mm-hmm.
Yeah. So let's say that scenario really happens. Do you expect that next bear market to be longer than the previous in 2008? Do you believe it will be worse?
It doesn't really, on a percentage basis, it doesn't have to be worse. Most of those were 50%ers. S&P.com top to its low is a 50% drop now, but for NASDAQ 100, which was the leader index back then too, internet stocks at that time, .com, it was an 82% drop over 2 years. So 29, it was a total wipeout to 1932. It might as well have been 100%. Okay. It doesn't really have to go that low. The issue is the duration and the pain that's associated outside of the market that is somewhat correlated and lagged to a declining stock market, like we saw in 2008. The headline pain didn't come at the outset of that bear market. It came in late 2008, a year off the high. So I suspect that's what you're going to see. But I think this time it could be speedier. Because most of the major markets right now are in technical positions to move at a more rapid pace. And I think if the stock market, for example, I'll give you some more specific ideas here.
Sure.
If you stall this month, we've rallied up and made a new high above that of March and April in the stock S&P 500 by several percentage points. And then we stalled. And when you look at the price chart, you can't see, why did they stop? They made a new high. They should keep going, right? But instead, for 2, now 3 weeks, we've stalled here. When I look at some of my momentum charts, that rally is up underneath a floor that was violated on momentum. So momentum says, hey, you're bumping a ceiling. Price, it doesn't show it. If we simply spin our wheels for the next 3 days, close out the month, 3 days after today, around these levels, we're in an extremely vulnerable technical position to begin the rollover next month and to really see real damage in the third quarter, in July, August, Sep. And I think when you see that, that's when you're going to start to get those data points that the Fed is probably eager to see, to give them excuse to go back the other way.
Yeah.
I already understand the ECB is ready to cut rates. I've heard comments in that regard.
Yeah. And Mike, how should an average investor play those bad times on the horizon? How can we prepare and act when the bad times come?
Well, you can say, well, I think I should be the short the stock market. Well, maybe so, but on the other hand, I suspect that the inverse of that is more profitable, and that is go to gold, but especially now, because our technical analysis tells us that since that 2020 surge in gold and silver in the gold miners, summer of 2020, is explosive percentage move. Silver and miners beat the pants off of gold in that move. Incredible percent gains. But since then, up through several months ago, the spread relationship between silver and gold and the gold miners in gold deteriorated. Why? Because gold mostly went sideways while those markets drifted. And so the performance readings weakened. But when you measure those technically, we had a breakout a month ago in the miners versus gold and in silver versus gold.
Yeah.
And where we think that it's now the beginning of the time where you see those components to the monetary metals, the silver and the miners, accelerate versus gold. So if I were to boil it down to one position, and frankly, this is what I'm doing.
Okay.
Rather than being short the stock market, yes, it's a factor. So is the T-bond market, by the way, and we have some views on it, which are somewhat confusing, but opposite the stock market for the time being. We think it's probably best to be in the monetary metals, especially silver and the miners at this point. The miners are probably the most undervalued they've probably ever been in history in terms of their percentage price relation to gold, or take GDX or XAU index and where they are in relation to, let's say, the US stock market. They're so vastly underpriced that it's almost laughable. Now, you want to buy cheap? Ponder on that. I think that's where you should be looking.
That's a good point. But Mike, let's say, what keeps Fed away from pumping more liquidity in the system and keeping this going on?
I think they'll immediately do it because, one, they have a problem this time around that they didn't have in the prior bears, where the T-bond market back then in the prior bear markets actually went up, meaning yields went down, okay? And the T-bond market wasn't getting kicked in the gut like so many other private bonds were. Like, the collapse of Lehman Brothers and private debt is in jeopardy. But if you'll look at the T-bond price action downside since late 2022 and compare it, for example, even to municipal bonds or to high yield corporate debt, it's weaker, meaning yields are higher. Why is the T-bond market under such pressure compared to other debt markets this time? That's got to be of maximum concern to the central bank, because when their instrument, their long-term debt instrument particularly, which they don't control as much as they do the short end, is in panic mode. And even Secretary Yellen has used the word, the illiquidity in the bond market concerns her. And she meant the T-bond market. That is something they don't like to talk about, because if they did, it would indicate panic. But they cannot have that debt instrument behaving like a crash market like it did last October, for example, or October of 2022. So that's got them troubled, ongoing, okay? And that market remains capped and under pressure. I think it could change, but right now that's the case. So that's a constant nervousness for the Fed.
Yeah.
And as soon as you start to get some bad data points, and I think they could come quickly, and already we started to see some, bad in the sense that they're less inflationary, because their inflation metrics aren't based on commodity action, by the way. It's too little emphasis on commodities, and commodities are resurging now. But when they start to get data points that indicate economic weakness, job market weakness, they will immediately rush back, because that allows them to help defend the T-bond market.
Yeah.
Putting liquidity and buying bonds, et cetera. So they're looking for an excuse, and I think that's why you got to watch the stock market, because I would suggest that if it even drops 5 or 10%, you're going to start to get the data points that the Fed will then say, aha, we have a reason to not only cease but drop,
Yeah. And you mentioned bad data. Definitely, I'm hearing and seeing some bad data for real estate market as well.
Yes.
Do you
Yeah.
see real estate as an elephant in the room also as a
Absolutely. In fact, we run charts on, there's a couple ETFs in the US that are REIT, real estate investment trust ETFs, and they reflect the softness in that, especially the commercial property sector. Now, Yellen is said, this echoing Bernanke's comments back in 2007, when he said, oh, no, the real estate market at that time, home real estate mortgage market, oh, it's manageable. Well, a few months ago,
that.
he said the exact same thing regarding and testifying before Congress that, yes, we realize there's a problem, but it's manageable. And I almost fell out of my chair. When you look at a chart, I suggest anybody want to do this, run a chart of the S&P monthly, go back a couple of years, like the 2020, and run a chart of RWR, it's a US ETF, or VNQ is another one. They look the same. And look what they've done since the 2022 drop. Totally coincident with the US stock market. They dropped hard, but since then they bounced, but about a third of the way back to the high. And they've gone dead comatose for the last year and a half or so in the bottom third of the price range, whereas the S&P went up and nipped out the top of the prior highs, largely due to, we know, 5 or 6 stocks. But real estate is anemic at best. And so we've got to watch the real estate sector, because if RWR and VMQ start to melt on down, won't take much in our opinion. We get some technical numbers about 5 or 6 points below where they are right now, that they're going to melt through those lows. And that's when suddenly commercial real estate is not manageable. And of course, the Fed will panic.
Yeah, let's say doomsday is coming, it's around the corner. So you would suggest that we want to buy only physical gold, or is there maybe an angle to buy not uranium, gold equities?
I suggest the miners are probably the greatest percent gainers over the next, by the way, I think this is going to be an accelerated process. I don't think we're talking the next 3 or 4 years. I think we're talking mostly this year and into early next. I think you'll have the type of price action that you had in silver and gold back in 1979. Look at a chart sometime, go back to the early 70s through 1980, and look what happened in the last year. Also go back and look at the 2001 through the 2011 bull market in gold and silver, and look what happened in the last year. I think we've already been going up from a low in 2015. So 9-10 years ago, okay, gold, 1,050. I think we're in the acceleration phase at the end of that market. The only difference this time is the external factors are far more serious in terms of generating central bank panic than at any time before. And therefore, when they panic, gold is going to be the prime beneficiary. I mean, if you're a portfolio manager and you look around and say, okay, what's doing well? It's a hard pick. And we've already had some major managers like Stanley Druckenmiller back in mid-February, dumped some big tech stocks and moved into Newmont Mining and Barrick Gold. Newmont's up about 30% since then. So, and a lot of other asset managers have also made that analysis and moved money out of the stock market into that category. I think if you're a non-levered investor, and there's difference now. We're talking, there's some people with leverage and have time sensitivity they could cope with, like options, for example. I'm heavily in call options, especially on silver related, and on miners, again, call options, but also own outright miners. But if you're non-leveraged and can't take the volatility and the time sensitivity risk, then I suggest just being long miners and outright silver bullion equivalent ETFs. There's several of them around. I happen to choose Sprott.
Sprott is a strong one.
So, but anyway, so it's up to the investor as to which medium But silver and the miners, I think, are the place to be. And I think it will handily beat any other category out there and will, to some extent, reflect the opposite of what's going on in a lot of those other markets.
Yeah, will silver outperform gold? Do you believe that?
Yeah, well, it's done it before. You look in late that 1979, for example, to 1980 move. I think silver went from, $10 to 50 in a matter of quarters. Look at the 2010. It was in late 2010, silver started to accelerate. It's been going up with gold all during the years since the 2001 lows, but in an arm wrestling manner with a lot of plateau regions, like we just went through the last 3 years in silver and gold. Plateauing bored the heck out of you. You didn't want to be there. You're sick and tired of it. Okay. So a lot of people vacated, but when it went into that acceleration phase late in the bull trend, in 2010, silver went from 20 to 50 in a matter of about 7-8 months.
Yeah.
So, and that wasn't even in the type of fundamental or macro situation we're in now, which could create something far, far more dramatic in terms of price levels.
Good answer. Mike, what are your charts telling you about the future price of gold and silver? Where I know that everybody hates that question, where nobody has the crystal ball. I get that part. But
Let me
do you
give
have
you
some projections of gold and silver performance, let's say in the next 12 months? What numbers can we expect?
There's no issue in my mind that the performance is going to be in silver. Okay. And it'll probably triple or quadruple what gold does. Okay. In percent gain. Go back and look at the prior bull markets in gold, let's say in the mid 1970s up through 1980. Yeah, there was a major correction in 1976 in gold. But basically, you went from the mid $30 level to the 850 level. Huge percent gain over a span of 10 years. Then look at the 2001 to 2011. It was an eightfold move. Okay. So you can say, well, let's say eightfold is sort of not abnormal. Okay. Well, we started from 1,050 multiplied times 8. Okay. That's to simply replicate what happened in the 1980 peak in gold. And that wasn't anywhere near the fundamental or macro situation we have now. So let's just throw that out there as a norm. Okay. There's another norm to look at. The silver versus gold situation. We measure it slightly different. Most people look at ratio. We do a percent thing. What we do is we divide an ounce of silver into gold. And right now, silver is about 1.3 something percent the price of gold. If you go back over the last 50 years, create a bar graph, which we've done and put in our reports, just to show people what's happened in the past. There was one time back in the 1970s, mid-70s, I think it was, silver got up to 6.5% price of gold. Okay, let's eliminate that as an erroneous alone situation. But there have been over 20 times in 50 years where at some point during each of those 20 years, silver got up to over 2% of the price of gold. Okay, and sometimes 3%. Okay, but let's just say 2. Well, if gold were to go to 8,000 and sort of do a normal, it did another eightfold. Okay, and silver were to go to 2% of that. Okay. Now, what if gold were to do something more dramatic?
Yeah.
Silver could easily be in a couple $100. I'm not going to put a number on it because when you're dealing with parabolic moves, and I think we're entering a parabolic phase, or what chaos theorists would proudly say, this is chaos. We're no longer incremental. Okay. We're now entering that by our metrics, and we can see the reasons why. We've been discussing that. Silver could go berserk. Think about it this way also. Copper made a high in 2011 at $4.60. At that time, gold was $1,900. Okay. In 2020, gold exceeded that high and went to $2,070. So, several percent above the 2011 price high.
Yeah.
Copper at that time went up to $5, also made a marginal higher high than it did in 2011. Okay. Now copper has gone up over 5. It's trading either side of that. So it's made a third higher high than it did in 2022 for copper, a couple years after gold made its 2020 high. So it wasn't in sync with gold. And its 2011 high. So copper's got these 3 peaks rising, and it's likely to accelerate as well. Gold is definitely going to accelerate, and it's out above both of those highs. Well, silver's old highs were $50. If silver were to merely catch up with copper and gold, it'd be somewhere over 50 right now.
Mm-hmm.
And it frankly would not stun me if in a matter of several months, within the next few quarters, that silver is above 50, doing what copper's already done and what gold has already done, catching up, in other words. And that alone would be dramatic, okay? Much less any other dimensionality that we've been talking about.
Yeah, yeah. Mike, are you bullish on some other commodities beside silver and the gold?
Yes, we measure, well, we measure them all. Actually, we do a monthly report, including like uranium, for example, grains, sugar, cocoa, coffee, platinum, palladium, you name it, copper, et cetera, and also the energy markets. And then we look at the Bloomberg Commodity Index, which is a pretty good index of all the commodities. It's fairly well balanced. There's a few commodity indexes out there that are overwhelmingly weighted to energy, and therefore they're really like energy indexes.
Yeah.
But when you look at that move that occurred, actually, we put out a report, and it was October of 2020, and the Bloomberg Commodity Index was coming up off of a low just below 60. It was trading up to 70, and we put out a buy report that said commodities are going to explode. Well, they went from 70 to 140 by early 2022. Now that happened, they peaked 1 month after the war began, Russia-Ukraine war. So the excuse that the central banks would like to use is, well, energy's up here because of that war. No, it was already up there before then. So were grains, so was sugar, et cetera, et cetera. So all that occurred before then. It was simply an issue of commodities being vastly underpriced to their historic levels. Like, in 2008, for example, Bloomberg Commodity Index was 237. Well, right now we're 105 or 6. So is that expensive? Okay. In 2011, when gold was making its peak, Bloomberg Commodity Index, I think, was 170. Okay. Way above where we are now. So commodities are vastly still underpriced in relation to their old realities. We had a pullback since the 2022 high in commodities, and basically it was reflected in all markets, crude oil, grains, you name it, they all pulled back pretty much, with a few exceptions, and they based. So since mid-2023, actually since all during 2023 and into this year, the Bloomberg sort of went sideways, dead, but it wasn't going down anymore. It was either side of 100. So it had about a 50% correction back to its bear low. We've now broken out by our metrics that says to us, we're commencing the next major up leg in the commodity complex. And this time, it happens to be coincident with gold. The last time it was totally uncoincident. Gold had already peaked. In the summer of 2020, commodities were just making their lows. But right now, we have a situation where Bloomberg is technically turned up, and you can see it in various commodities within the complex, coincident with gold. So the last time that happened in a major way was what? The late 1970s. And we had what Jamie Dimon says we're going to have now, stagflation. And I think that's frankly where we are.
Yeah. Final question. What's your take on Bitcoin? How will cryptos perform in that circumstances you just mentioned? How do you see them?
Yeah. Bitcoin does have some virtues. The prime virtue is it's not like a fiat currency. It can't be expanded at a wish of a central bank in terms of quantity. And, it's hard to grow it, okay? The problem with Bitcoin and the other cryptos is they're more traceable than gold in terms of if you own them, the government knows it and can know it if they wish to. And therefore, as an alternative or a place to sort of put your money that is safe from being, whatever concern you might have about the government doing something about it, it's accessible. And that makes it vulnerable. And I think that's a vulnerability that people will ponder on. Technically, Bitcoin is now behaving more like the NASDAQ 100. In fact, if you overlay the chart over the last year or so, like since late 2022, overlay a chart of Bitcoin with NASDAQ 100, you'll see quite a similarity. including the recent surge. Bitcoin made an all-time new high. What happened? Nothing. Made a new high and stalled, dropped back down to 70,000. We've got some we do technical analysis reports every 2 weeks on Bitcoin and Ethereum. They both have a similar situation from a momentum vantage point. And that is that they have built a trend structure that's not evident on the price charts. The price charts are upward curves. It's hard to draw a trend line even because it's curves. But when you draw a momentum chart, as we do, a long-term momentum of Bitcoin or Ethereum, there's a trend structure that they've been hitting repeatedly. So you can draw a line to about 5 lows. It lines up perfectly. You can't sneeze. You go back down under 70,000 again, which we were, a week or two ago. You do that in the next several weeks, you probably have a technical breakdown. And I think at that point, you'll probably be seeing NASDAQ 100 having a technical breakdown. So to some extent, I think Bitcoin is moving speculatively, somewhat irrationally, and more in line with the rabid money flows into NASDAQ 100, for example. So I think it could burst with the stock market. So be careful. I don't think it's going to beat gold, period.
Okay. Sorry, this is the final one. Uranium. What's in the cards for the uranium? This is my favorite commodity. What do you see over there?
Well, unfortunately, MSA got bullish on uranium in the low $20 zone back in 2018.
Yeah.
It had collapsed off the page. We were going green, right? Okay, we don't need uranium. Okay. Annual momentum of uranium broke out at that point, a couple different ways, such that we pounded the table and said, uranium's going up. It's a bull trend. Nothing since then has altered the annual momentum bull trend of uranium. There is an uptrend structure on momentum that you can see. You can't see it on price because, again, it's a sharp curve. Frankly, at this point, uranium looks like it could suffer a pause, congestion zone. I don't think you're going to have a collapse such that over a period of time, it doesn't do what it just did, which is quintuple. Okay. Which is fine. I mean, it's come back to reality. And I think from an investment point of view, yes, it's got a new reality. Forget those old lows. You're not going back there. Reality was false then. Okay. Exactly. And I suspect the better place to be in uranium now are the uranium mining and producing companies. URA, I think, for example, contains a lot of the companies that we're talking about. And that they're not so overvalued as uranium is at the moment in terms of gaining too much too fast. And I think they'll do a catch up to uranium. But again, from a point of view of do I enter long uranium at this point? I suspect it's not a good idea. Not because you're going to get killed, but because you might get bored to death. Okay. But it definitely it found its new reality, and it's not going away. Okay.
Yeah. Okay. Thank you very much, Mike, for coming to my show. It was a great chat, as I expected, and let's catch up sometime soon again. Thank you very much,
Lucian.
sir.
Thank you much, Lucian.